In mid-October, we published our update to our 2024 market and economic outlook. We titled it Gains Continue, What's Not to Like. We thought it'd be helpful to provide a video summary of that report with a few charts. So over the next several minutes, I'll focus on 5 key topics that we profiled. An overview, number one, the S&P 500 index valuation is elevated and is near the upper end of our expected range. Number two, the sector rotation and changing leadership seen in Q3 can continue. Third, we see no recession for now, but consumer spending can be fragile. Number four, the path to ever lower interest rates is not a certainty. And then finally, underappreciated risks include election results, geopolitics, and the US budget deficit. The widely followed S&P 500 equity index increased 23% in 2024 year to date as of October 18th, and gained more than 60% in the 2 years from the last market bottom in October of 2022. While there are several metrics to assess market valuation, one of the most popular is the price to earnings, or the PE ratio, and the PE is just the price of the index divided by the weighted average of the earnings of all index constituents. With earnings a key component of the PE, we focus on that to show the earnings growth quarterly compared to the same quarter the previous year. Looking at the past 5 quarters of year-over-year reported earnings growth in green, growth has trended higher from 5% to about 11 to 12%. And looking ahead, the percentage growth estimates in gray improved to the low teens. This is good growth, but because the S&P 500 index gain is well above 20% this year, the PE has expanded, so the P has grown faster than the E. In fact, the PE on the S&P 500 using estimated earnings for the next 4 quarters has moved to 22 times, its highest level since April 2021 during the COVID-19 pandemic when markets had recovered, but earnings remained depressed due to the shutdown of the economy. The current PE is a 33% premium to the 25-year average of 16.6. And even if you look at the past 10 years, a period of elevated PEs that average 18.3 times, the current level is a 20% premium. Both stock prices and earnings estimates look ahead, which of course is uncertain, so perhaps investors see better earnings prospects than the 14% or so that's priced in. And there's no rule to say that the PE ratio won't remain high for an extended period of time, and in the short run, with solid momentum, it could even go higher. However, we don't expect multiples to expand from here, and over time we look for a reversion to the mean. In our view, this limits the upside in the S&P 500 over the medium term, several months or so, and as prudent long-term investors, we should scale back our return expectations. Included in our view that S&P 500 index gains are likely to be muted from current levels is that the composition of index gains in the third quarter was very encouraging. All S&P 500 constituents are categorized into one of 11 sectors. Each of the sectors by market capitalization comprises a certain percentage of the index, and that changes over time. And at the end of September, the 2 largest sectors by weight were technology and financials, and the smallest was materials. In the first half of 2024, just 2 sectors, technology and communication services, drove the bulk of the S&P 500 gains, but that changed in the third quarter, shown on the chart here. The chart shows the returns by sector for the 3-month Q3 period, and 8 of the 11 sectors posted gains greater than the index, and investors were rewarded for sector diversification. One reason is that valuations in many sectors are lower than for the overall index and attracted value buyers, and another is that resilient U.S. economic growth has led to investors looking for opportunities across the economy. Another way to view the sector impact on the markets is to compare the return of the S&P 500, which is weighted by market cap, giving the largest companies the most influence on returns, to the equal weight S&P 500, which assigns all of those same companies an equal weight. When the biggest companies are the best performers, the market cap weighted index will outperform, and that was the case in 2024 through September. The S&P 500 gained 20.8%, and the equal weight S&P gained 13.5%. But that difference peaked mid-year at the end of June, and in the third quarter, the equal weight S&P increased 9.1% compared to 5.5% for the market cap weighted index. In our view, this is likely to continue, and investors can find better relative value in stocks and sectors that have underperformed and are still driving solid expected earnings growth. And this includes stocks that span multiple sectors, and it can include financials, industrials, healthcare, and materials, and even others. With the exception of a soft patch in the first half of 2022, coming out of the pandemic, U.S. economic growth as measured by gross domestic product, or GDP, even adjusted for inflation, has exceeded expectations. This has mostly been driven by strong consumer spending, but we also emphasize a positive impact of continued business investment spending to support artificial intelligence projects. The chart shows the quarterly annualized GDP in green, and the annual GDP numbers are shown across the top. In 2024, second quarter GDP of 2.99% was better than the first quarter, and from much data that's already been reported, Q3 looks like it's tracking in above 3%. While many factors have contributed to consumer spending, including wage growth, accumulated savings drawdown, and rising credit, the most important factor in our view has been a strong jobs market. So despite a good jobs report in September, growth has decelerated from earlier in the year, and we are watching that closely. Spending trends are likely to remain solid in the fourth quarter, but a slowing consumer remains a risk in 2025. With economic growth remaining above expectations and consumer inflation data moving lower throughout the year, U.S. interest rates have moved steadily lower. The U.S. two-year Treasury yield was 5% as recently as late May, but just 3.5 months later, by mid-September this year, the yield dropped to 3.5%. Investors were ahead of the Federal Reserve Bank, or Fed, the body that sets the very short-term interest rate targets by managing the overnight federal funds rate. And in early 2024, the Fed had set expectations for a lower Fed funds target, but didn't enact its first 50 basis point interest rate cut until September 18th this year. And then perhaps unexpectedly, since that date, the two-year Treasury yield has moved higher, back above 4% as of late October. The path to much lower rates might not be as linear as many expect and could lead to volatility if inflation progress stalls and leads to higher interest expense for consumers, businesses, and the government. The final point in our October outlook concerns risks. While we assess the outlook for earnings, interest rates, and market PE ratios, we should remember that market pullbacks are common and investor sentiment can be negatively impacted by post-election volatility, escalating global military conflicts, and ongoing U.S. budget deficits that continue to add to the national debt. For this reason, we're attracted to leading companies that command market share, have resilient profitability, and strong balance sheets. You know, the best-run companies, true leaders with great management and competitive advantages, can optimize results across business environments and political shifts. Thank you for watching this video. Stick to your long-term investment plans and rebalance portfolios as needed. For specific recommendations and strategies, please contact your D.A. Davidson Financial Professional.